together for the Greenwich Forum about a year ago, this time, the world was in a very different place.
Well, the very fact that it has taken such a long time to unwind makes you very cautious about where is the beginning and where is the end. Mm-hmm. And I don't know the answer to that question. I doubt if anybody really does. But COVID has been a disastrous world-killing area, if I may use an odd term.
Yeah.
And it's still with us. I still think of COVID as one of these most dangerous phenomenon that the human race has confronted in quite a while. It's been a very big hole, and it's not over.
And Alan, it's hard not to ask you this question because, again, with the kind of inflation that we have today, we have inflation that is running at a very high rate. We also have pressure on wages because at the same time as we've had this inflation rate, we also have had high employment. So with that scenario, often people will say that wage increase is going to just result in higher inflation. Is that your view?
The answer is yes. It is my view. Ultimately we know that inflation is a function of increasing costs by definition. Mm-hmm. And you get a situation in which wages are rising, you are going to get inflation. And it's inevitable, as arithmetic is inevitable. The degree is the other question, and the extent to which it can be eliminated is the third question. But there's no doubt that wages are related to the whole phenomenon. So the first thing I do when I'm looking for inflation is look at the wage structure. Mm-hmm. And it doesn't fail you in a forecast because it's fundamental to where inflation comes from. Inflation is ultimately not completely, but significantly impacted by the cost of labor. And so long as you have an economy which is very labor intensive, you are going to have inflation.
But what if wages go up at the cost of retained earnings and earnings go down, so that you come out of the recovery with lower profit to the shareholders, but higher wages, and the wage earners are going to be spending more than the other stakeholders.
You tell me where wages will come out, and I'll tell you where inflation will reside.
Very good. In terms of one of the other subjects that we talked about last year, and it has continued surprisingly into this year, it's the supply chain problem.
Well, it will be until it's eliminated or significantly reduced. I think it's come down a bit, but that's difficult to prove. And all you can say is that history tells you it does go away. So if you can stand it, grit your teeth, it'll go away.
And I won't go back to the tape of last year to see whether we were right or wrong, but of course we were right. You were right. Thank you, Alan, as always.
My pleasure to be here.
With the economic growth of China, the financial market has become more active. The number of high net worth individuals has grown rapidly. Asset allocation has become increasingly diversified, and the wealth management industry has a huge market potential. Noah is a leading high net worth wealth management service provider in China with global asset management capacities. We were the 8th largest wealth management service provider and the largest independent wealth management service provider in China. Both in terms of total revenues in 2021. We focus on providing professional financial services to high net worth and ultra high net worth investors. Noah works with worldwide top-tier general partners and fund managers and connects leading asset managers around the world. Noah offers comprehensive financial services, including wealth management, asset management, and others. Wealth management business offers a diverse suite of investment products, primarily including mutual fund products, private secondary products, and other products. Asset management business offers proprietary and unique investment portfolio, specifically designed for our clients. Other business mainly includes lending services and value-added services. Noah adheres to the client-centric value. Our Noah Triangle service model matches highly professional advisors specialized in relationship management, various investment solutions, and execution fulfillment to serve our clients' asset allocation needs. We have achieved significant growth in scale and profitability since our inception. Our total transaction value in 2021 was RMB 97.2 billion, US 15.3 billion, compared with RMB 94.7 billion in 2020 and RMB 78.5 billion in 2019. Noah is a pioneer and leader in China's high net worth wealth management services industry. We are committed to creating value for our clients and focusing on innovation. With 17 years of professional heritage, renowned at home and abroad, we have accumulated and served a high-quality and loyal client base. We serve our clients with a comprehensive suite of investment products, as well as provide them with extensive resources and education. Noah is the first wealth manager in China to have built a unique and strong ecosystem with top-tier fund managers and general partners in various asset classes. Our technology capabilities and infrastructure are top-notch in the high net worth wealth management services industry. A fully integrated technology infrastructure combines the human touch with a digital core and improves the work efficiency of the Noah Triangle service model. We have benefited from the vision, experience, and professionalism of our co-founders. We have successfully navigated the changing market environment. During the track record period, the good market performance demonstrated the steady development of the company. With 17 years of in-depth understanding of clients' investment needs, we have established a widely recognized brand, becoming a trustworthy and sustainable wealth manager. Noah actively undertakes corporate social responsibility and makes great efforts in public charity, women's empowerment, and sustainable development to help realize the better, low-carbon, and green development of China. We aspire to serve worldwide high net worth and ultra-high net worth clients as the most trusted wealth management advisor from China. Going forward, we will maintain and expand our client base, continue digital transformation, improve research and investment capacities, optimize our product mix and maintain our product leadership, and expand overseas.
诺亚作为中国领先的财富管理公司，致力于可持续发展， 履行企业社会责任，以客户为中心，为客户创造长期价值。诺亚将心注入，与客户代代相伴。
Enriching life with wealth and wisdom.
Hi, welcome to the discussion on China today, where we're going to look at some of the opportunities and the environment. We have a terrifically diverse panel today, which will give hopefully an insight to all investors and those listening to this conversation, sort of an insight of the issues that are going on in China, an update on where China's at, and also many of the opportunities that are going to be available to investors in China. I'm often asked by people about China. There are some who are concerned, some who are looking for opportunities, but I think all of us as investors have to have a view, have to follow the Chinese market, because China will be and will continue to be a major investment opportunity for all investors around the world. So I'd like to just introduce the panel, or the panel will introduce themselves. I'll hand over to you, Tommy. Could you tell us a bit about yourself and the background and your work at UBS?
Thank you, Mark. My name is Tommy Fang, so I'm head of global markets for UBS China business. So I've been in the industry for over 20 years, and for the good part of the past 10 years, being more managing the UBS China business. So obviously, I've been at the forum for quite a few years in person and also virtually. It's great to be here again with the great lineup of panelists. So obviously UBS has been a critical participant and also key beneficiary of China opening. So we were the first QFI, still one of the key players, both through Connect, QFI, and onshore now we have more than 1,500 people on the ground working with regulators, exchange, and onshore investors. So definitely looking forward to the discussion today.
Thanks very much, Tommy. I'll now hand over to Yin. Could you tell us a bit about your own background?
Sure, thanks, Mark. Hi, I'm Yin. I'm a Shanghai-based partner at Kun Law offices. Kun is one of the top PRC law firms. And myself, actually, I've been practicing law in the cross-border asset management and financial services areas for almost 15 years. And before I joined Kun about 4 years ago, I worked at Clifford Chance and have worked at the international law firm for almost 10 years. And my clients, most of them are international asset managers, trading houses, service providers. So over the years, myself and my team, we have advised many global asset managers and financial institutions on their business, on their China-related business. And it's such a pleasure, to witness and get involved when they continue to further their footprints in China. Yeah, I look forward to the discussion today. Thanks.
Thanks, Yin. Dr. Pang, about your background and your very interesting kind of specialization.
Thanks, Mark. My name is Yang Pang. I'm chairman of Chelion Renewables. This is a renewable energy technology company headquartered in China with branch offices in Europe, US, Japan, and Australia. We work with international investors in renewable energy projects, and also we have technology solutions that's mostly in China and serve a global investor base. My own experience, I have been in renewable energy investment for the past 10 years, and generally in investment financial service industry for the past 20 years. And before that, I had 20 years of experience in theoretical physics. So today I would like to share with the panelists as well as all the conference attendees renewable energy related opportunities both in China and globally.
Thanks very much, Dr. Pang. I think if there's one major trend, it's the trend towards renewables. So we're really looking forward to hearing your insights both in China and around the world. And just finally, Grant, you're also at a very leading firm, particularly in high net worth, servicing the high net worth sector. Could you tell us about yourself, please?
Sure, thanks, Mark. My name is Grant Pan. I'm the Chief Financial Officer for NOAA Group. We're a U.S. listed company since 2010. Serving similar sector clients like Tommy's, UBS. We actually do look up to UBS, our role model in China. Hopefully one day we'll be China's UBS. But obviously we're still very young. We have about $150 billion US placed for our clients cumulatively since we're founded in 2005. And currently have about $40 billion US AUA for our clients, basically ranging from private market, secondary market products. And we rank about number 8 in total private banking related revenue. But if we look at independent wealth manager, meaning that we're not a bank or security brokerage firm background, we're definitely the largest independent firm serving our clients. So I think it's a very representative group of clients as they mostly are the entrepreneurs of China, which representing a very active part of the economy. So very happy and excited to share what their views are, and looking forward to hearing our outstanding panelists' views. Thank you, Mark.
Thanks very much, Grant. So we'll start off with the sort of macro markets environment to set the scene. It's fair to say that all global markets are moving to their own sort of beat at the moment, somewhat on a negative front. But China's got its own dynamics. And just to set the scenes there, Tommy, perhaps I'll turn to you first if I can. Could you tell us about the market, economic and policy environment, particularly as we go into the National Party Congress? What do you think will occur in 2023? And perhaps just set the scene for us. And for those who don't follow China, give them an update on where the markets are at. Thanks, Tommy.
Sure, Mark. So obviously very critical. We have the overall global macro backdrop of quite a challenging environment with the key developed market, all the central bank on the rising interest rates to really fight against increasing inflations. So obviously geopolitical with the war in Ukraine and also potential energy crisis leading into the winters, and also obviously we all looking at to resolve with the climate change and how that dynamic will feel into the real economies. So bring a little bit closer into China. So 2022 is a critical economic and also political years. The top policymaker wanted the year to be as stable, but this year turned out to be anything but stable, right? With the geopolitical energy and all the macro environment. So we do forecast China's experience slowing down with potential pickup in Q4 on the back of recovery from the tighter COVID policy-led economic slowdown, especially in Q2. So we're looking at sub 3% overall growth of GDP this year, potentially recover to 4+ level for 2023. So Mark, as you highlighted, but from a monetary policy front, China is definitely on a very different path. There are a lot of liquidities. The overall monetary policy has been, more or less on the losing or relaxing side. So that can potentially set a theme, in my view, despite all the sort of the geopolitical dynamic and also the regulatory uncertainty market participants and the policymakers have been working through. So because of the rates environment, the potential rebound from COVID, and also the liquidity is very ample on the ground. So from a diversification, allocation, and also valuation point of view, China equity market can potentially outperform next year, in my view.
Tommy, I might just ask you a follow-up question if I could. I was meeting with a large sovereign fund that's a huge supporter of China, has a large allocation. They were also asking the question about extra stimulation, extra government policy towards encouraging growth into 2023, perhaps after the NPC. What's your firm's take on that? Do you have a sort of read on that at this point as to what could happen? I know it's speculation, but what are you thinking policy may lean towards into 2023?
Well, we actually have seen the overall policy both on the monetary and the fiscal front has been in general accommodating. So obviously there have other priorities, whether it's common prosperities or whether it's really on the overall COVID policy front, right? So NPC is around the corner, so it's, everybody's focusing on it. So our view is we wouldn't recommend our global investor to expect some immediate quote unquote good news, whether it's full pivot from the COVID zero policies or massive stimulus, right? But I think we do expect with the upcoming 2 sessions in March, the focus and the priority will be more and more focused on economic growth. So that will set a scene for recoveries. So that's our advice to our clients.
Thanks, Tommy. I might just move to Yin first. We've got a really diverse panel here for a deliberate reason. One of the reasons is that as you'll hear about the macro environment, the investment environment, perhaps the contrarian opportunity to enter the market, a question that investors have is around the legal structure, the regulatory change, and really need to be kept up to date on where that's at. Generally, it's favourable, but there are those who are cautious about it. And Yin, you advise people on a regular basis, I'm sure relatively new investors as well as seasoned ones. Could you give us an update on the regulatory environment you're seeing at the moment and also the sort of prospects into next year?
Yeah, sure, Mark. One of the key features of the Chinese market is that, when you enter into the market and start doing business in China, you will find out that, the regulatory and legal environment will continue to evolve in China, well, especially in the asset management and foreign investment sectors. But I think, as mentioned, my team, we have been in these areas for over 15 years, and our practice actually grows with China's opening up policies in the asset management and financial sectors. So, based on our observations, we think it is generally a irreversible journey, for the PRC government to continue to open up the markets, because China's, for example, China now has the world's second largest equities market, second largest bonds market, fixed income market, and also very large futures market. And by AUM, China's asset management market is also the world's second largest, just after the United States. So, this is a huge market with great potential. However, if you look at the current foreign participation, it is still quite limited. Not only compared with the developed countries, but also compared with some of the emerging markets. So I think the government, they are determined, to make the markets more liberalized and also more international. And as you know, Mark, China's equities and bond markets, they have been included in the global indexes, MSCI and also the global fixed income indexes. So the foreign investors community, they are also having a increasing demand to allocate more RMB assets. So I think it's we have the demands from the international investors community, and also on the China side we also have the willingness to supply and to accommodate to those demands. So I'm generally optimistic, about the future regulatory trends and the developments. And also, if you look at what has happened in the past 12 to 24 months, we do have some very positive legal developments and regulatory developments. The government is continuing to implement the opening up policies. For example, we have seen the first batch of wholly foreign-owned fund management companies in China, set up by BlackRock and the other big asset managers. We have also seen the very first batch of the foreign-controlled, wealth management companies, which is joint ventures with the big Chinese commercial banks. Like the ones set up by Goldman Sachs Asset Management, etc. So yeah, I think the government is implementing their opening up policies, and they will continue to do that.
Thanks very much, Yin. It reminds me of I had to give a speech in, I think it was 2018 at the Bund conference for another role that I have, and we were talking about the policy, and I think it's important, despite all the dislocation that we've seen in recent years around the world with COVID and other issues, it is very clear that China's policy of regulatory opening and change has been consistently applied now. And I think that gets forgotten as people sort of look at perhaps China afresh more recently. So it's an excellent point. I'd like to move back to the macro again, if I can, to Grant. And you're advising high net worths and you're positioning portfolios. What's your take on China, and how are you thinking about it relative to global markets?
Yeah, we have been seeing quite challenging 2 quarters in the first half of this year, especially evidenced by the complete slowdown on the subscription to secondary market security firm equity securities, especially. So that's usually a big sign of reflection of people's confidence over, a probably not a long-term, but a short-term future in terms of the economy growth rate. So I believe overall it's still very challenging, especially like the 2 panelists have mentioned, with restructuring as well as the adjustment post-COVID policy. I believe everybody is thinking, I think one of the common acknowledgement is that the relief on the COVID control policy is probably around the corner. And many of our clients are entrepreneurs, they're preparing for the recovery post-COVID time. But at the same time, I believe it's still very difficult, at least from our perspective, to see their clients making significant investing decisions, especially domestic opportunities. It's actually also our CIO's view that this is probably a year that you take safety real assets higher priority over growth from especially a personal and family planning, wealth planning standpoint. But at the same time, we're also happy to see that our investor bases, they are more sophisticated and more open-minded, especially for the last couple of decades. They're more willing to look at global asset allocation opportunities. So they're able to look at these investment opportunities more objectively. That's why we are thinking, with the imminent recovery of Chinese economy, we'll still see a consistently increasing demand in terms of allocation of asset over a global spectrum, rather than just very focusing on the domestic part. I think that's actually quite a healthy transition in terms of people's philosophy on asset allocation and wealth planning. We actually have a rather interesting observation that, how the Chinese entrepreneurs is going into probably phase 3 of globalization. The first phase obviously is the Made in China, the huge success of our export-based, manufacturing, as well as some of the, commercial tradings. And we're probably seeing the next phase is where our entrepreneurs will probably seriously looking at expand their operations and establishing headquarters overseas. That's probably rather fresh comparing to before, that people just look to either strengthening their export or doing some outbound investment to further expand their business. But rather, I think it's interesting to see how they're seriously thinking having a second headquarter or even global headquarter to actually establish their business presence overseas. So with that, I believe we're seeing a more globally minded economy, as well as that group of entrepreneurs of China.
Thanks very much, Grant. And that may surprise some people, because I think people think of closing up rather than opening up. And it certainly does, from a Chinese investor's perspective, give better diversification, which at the end of the day is better for the solidity of the Chinese financial system as well.
Absolutely.
So, thanks for those observations. Well, we're fortunate to have Dr. Pang with us, who is a specialist in renewables. And I think we can say without exaggeration that for particularly European, some US, Australian and other countries, reducing and setting carbon targets for portfolios is a very strong key focus, and has been over recent years, but has really picked up intensity. Dr. Pang, I'd like to ask you, though, about the renewable environment in China, the investment opportunities and the developments that are occurring in China. I'll come back a little later on in the discussion today to ask you more globally, but could you give us an insight into the Chinese situation and how you're seeing as a specialist firm in that area?
Okay, thanks, Mark. I agree with your statement that renewables certainly has received a lot of attention in the recent years. And this is not just because of a global climate change and also carbon neutral target, but in recent years, especially this year, people recognize that having energy independence, having energy security, and moving away from fossil fuel has many other advantages. And on renewables, China and developed countries, Europe, US, we are much more in common than in other areas. It's one of the few areas that there is a consensus that we need to work with everyone, not just developed countries, developing countries as well. So China is fully committed in renewable energy development. This is not just renewable energy technology, renewable energy products, but renewable energy projects. China is the largest in terms of installations of renewable energy projects globally. And it is also because of the last 10 years effort, to a large part of effort in China, that renewable technologies like solar power and wind power, the cost for this energy moved from the most expensive 10 years ago. 10 years ago, solar power was the most expensive electricity compared to any other technology. But right now, it is the cheapest technology to generate electricity. And this all happened in the past 10 years. And then moving forward, the next barrier really is the storage, since we only have few hours of sunlight each day. So how to store the energy you generate during the day, and then be able to use it throughout the day and also across different seasons. That will be the next challenge. So energy storage is the next challenge. And as a result, from both inside China and as well as globally, the interest as well as the focus from investment, from the opportunities in the next few years will be heavily focused on storage. So I invested in a company in Japan doing mostly solar-related project development. And the new company, Chelion Renewables, that we established last year, our focus will be mostly storage-related technology and solutions. And the second, I echo what Grant said earlier. Rather than a local-focused business, we are actually much more global. From very beginning, we established ourselves as a global company, not just to sell technology to other countries. We're actually setting up headquarters in other countries as to much more closely involved in project development, much more closely involved in the business. And we're also very open and eagerly seeking to build factories as well as to integrate technologies globally. So this is actually a trend. So in a sense, that some of the what people perceive as maybe China is closing up, in fact, is actually forcing and encouraging more Chinese companies to be global. And we are one of the examples. Actually, we don't see ourselves as just Chinese companies selling product overseas. We see us as working very closely with countries overseas to together to develop a more renewable world and also to work towards carbon neutral target.
Thanks very much, Dr. Pang. We're picking up a theme here, aren't we, which is a sort of two-way flow issue between China and the rest of the world. We heard that with the discussion about the high net worth market also. So we've discussed sort of the macro environment, and we could talk about this for some time. There's a lot to be debated. There's a lot of change, but I think we could probably say that China is on a different cycle. It is looking for a recovery environment. A lot of bad news is priced in. And it's really up to investors to form a view about that and the timing of that and how to get positioned. But Tommy, I'd like to talk about the next stage, which is really the developments that are occurring then for allowing for liquidity into the market, some of the work you've done with the Hong Kong Exchange, I think the Financial Services Development Council and others. Could you tell us, and QFI and all the changes that are going on there, how is access developing? Could you give us an update? Just particularly for those who perhaps think that access has worsened and not got better. There seems to be a bit of a tone here that some people give, which I think is very incorrect. Could you tell us a bit about what's been developing there?
Sure, Mark. So obviously, it has been, challenging, 18 months, for China investors, so especially from a sort of a long lease and the more longer term horizon global investors, perspective. So there are areas of, I think Chinese regulators have been, focusing on taking suggestions from firms like ourselves, Noya, and all the partners like Ms. Ge's firms. So some of the areas to focus is really to clarify the roadmap, right, and have that sort of interaction, communication with international investor when it comes to sector or regulatory developments. So in terms of the access, actually, we have seen, as Ms. Ge alluded to, continuous increase, right? Whether it's the Connect scheme, there are a new initiative, whether it's including ETF into the Connect, working on swap, Connect, and also most recently for the QFI relaxation, where commodity futures, index, options, and some of the new instruments finally become available to the global investors. So we will see, in many ways, investors globally or domestically are all working on their portfolio, looking for alpha and beta, right? So when the investors are not doing well with their strategies, they will take a pause, right? So we definitely see 1/3 of our global investors are taking a pause to review the overall risk premium of investing into China. But as other panelists mentioned, the overall size of the capital markets of China versus the allocation, whether it's 4.5% for the Asia equities or 3% for the bond market. So from the overall allocation perspective, there are definitely more upside to go. So I'll just touch upon very quickly. We can go a little bit further. Hong Kong obviously continues to be that super connectors between China and the world, with many listing regime changes, and also it comes down to the liquidities, where there are a lot of questions or sort of concerns, right, from global investor on how to improve Hong Kong as a trading venue from a liquidities perspective. So UBS, myself, we've been working quite closely. I think the key focus, so I would say one is, if you look at the market microstructures, so Hong Kong tend to be really lacking the liquidity providers, such as ETF players, market makers, high frequency trader, and all of those roughly account for more than 2/3 of, for example, US market, where Hong Kong is less than a third of that. So to focusing on improving liquidities, so that includes how some of the specific measures for those market participants, ETF and etc., from a cost and the efficiency point of view, and also some of the other enhancement, whether it's clearing, whether it's knowledge enhancement, and obviously the overall cost, right, which in many ways outside of exchange and other market participants control. So those are the areas we've been working very closely. We can talk a little bit more detail on the connect. I definitely agree with Grant in terms of this is a two-way flow. So Hong Kong is a venue, not only global investor investing through Hong Kong into China, but also for Chinese investor investing to the world, right? So in terms of enlarging the southbound, improve and increase hedging instrument for Chinese domestic investor investing overseas, right? So those are a very important area. So we should work together.
So thanks, Tommy. And I think the other feature that we've seen recently, as some international investors have repositioned their bond weightings as the bond yield differential closed, the gap closed here temporarily, we've seen flow coming out, which I think should give people comfort about the two-way aspect of the market, which gives it long-term sustainability, I think, when you can see those flows being actively done without any particular concerns or issues. And I'm sure it'll flow back the other way as the appropriate time comes. Yeah. Just moving to Yin, I understand your firm's done a lot of work on the derivatives market. Perhaps you could give people an update on what's developed there and what your sort of observations are. I think this has been a major deepening, as Tommy was also mentioning.
Sure. Well, derivatives and futures trading is one of my practice areas. So in the past 12 months, we have seen many positive developments. Actually, one of the most noteworthy developments is that the PRC futures and derivatives law was finally adopted. And the law was passed in this April, and which became effective in August. So this actually provides a basic law, for the China's futures and derivatives markets. All the market participants, the regulators, as well as the international investors, anticipate, this law will lay out, a very good, foundation for the future developments, as well as the two-way opening up of China's futures and derivatives markets. Also, in relation to passing and the effectiveness of the PRC futures and derivatives law, ISTA have announced a new PRC legal opinion, which recognizes the closeout netting, the enforceability of closeout netting under PRC laws. And anyone in the derivatives industry would be quite excited, about this developments, especially those international firms which have been, trading derivatives with the PRC firms, because the recognition of the closeout netting jurisdiction actually gives the firms much more certainty when they trade the derivatives with Chinese counterparties. And that will also enable them, to do more effective risk management. So that's another very encouraging developments. And again, that echoes with my earlier comments. because those developments are all the outcome of the continuous efforts taken by the PRC government to make the market more international. And also we have seen, well, as Tommy mentioned, not from this September, the QFIs, the qualified foreign investors, they are allowed to trade futures products in China's all three commodities futures exchanges. So that's another long-awaited development. And of course, for U.S. investors, because of the CFTC fighting issues, for the time being, they may still have certain difficulty in directly trading the futures products on the PRC exchanges. But I think the regulators and the exchanges, they are aware of this issue, and they will work on it, to resolve it soon. And also we have seen this Swap Connect, which is another mutual access program, to allow the foreign investors, overseas investors, and PRC investors, to trade on each other's interbank interest rate swap markets. Yeah, so those are all very positive developments we have seen in China's futures and derivatives markets.
Thanks, Yin. Thanks, Yin. As you mentioned before, you mentioned long awaited, but I think the other way to view that, which we've discussed a couple of times here already, is that these policies and expected policies have been put in place over a long period of time, and they continue to be sort of delivered at, and this includes opening up the market to foreign financial firms, but also the development of the capital markets, and as we mentioned a moment ago, about two-way flow of investing. Perhaps turning now back to renewables, if I could, Dr. Pang. You mentioned about China, but you have fabulous experience. I think you've been an investor in at least 5 or 6 different regions in your career. And so you're able to compare renewables against each other. And I know your firm does this on a global basis. Could you tell us about the opportunities in China relative to the opportunities you see elsewhere, and also some of the new renewable energy areas that you're focused on, perhaps in China, which I think foreign investors are aware of, but perhaps could do with some more insight on. Thanks.
Thanks, Mark. Renewable energy development in China and compared to in Europe and US, there are some key differences. One is for now, at least renewable energy projects like solar power or wind power, they are relatively large projects in China located in remote areas. So these are central power stations, and they are usually developed or at least owned by state-owned companies like State Grid. However, in US, Europe, Australia, and in Japan, there are lots of small independent power producers, and also there are far more distributed power stations. So one difference is the investor base, especially the long-term holder of those renewable energy projects, are quite different. In China, for the moment, it's a state-owned enterprises. But I do think China will gradually move towards a more market-oriented renewable energy investor base. And there are recent developments, especially there are financial vehicles, financial instruments being created, being tested in the last few years. For example, REITs. It is instrumental in many countries as a holder or the last investor of a renewable energy projects. REITs and in US YieldCo are natural investment vehicles for renewable energy projects. In China, these vehicles have become available in the last couple of years. Another one is in general, securitization is also a suitable instrument. And there are another requirement for many of those projects to become more market-oriented rather than predominantly owned by state-owned enterprise is the free up of the electricity market. So allow electricity to be more freely traded as an instrument. And there are movement towards that. And I do believe that China, although at this moment, many of those in renewable energy, in electricity, are not quite as market driven as in other countries, but it is certainly moving towards that direction. And the renewable energy development for now has to be global. The reason is a large amount of renewable energy related technology, for example, PV cells, lithium batteries. These are predominantly produced in China and installed everywhere. So renewable energy, I find, is one is that as an investment for overseas investors, needs to look into China to look for these renewable energy companies like us or like many others. So this is one hotspot of the Chinese equity market in the last few years. And I believe this will last for many decades because carbon neutral target is not for the next 20 years, 30 years. It's probably going to be for the next half a century or even a century. So this is a long-term global effort to reach carbon neutral. And China for now dominates in certain sectors, but even these sectors require global collaboration. So I think this is one of the areas that's a tremendous investment opportunity in China, in these companies, as well as in the future in renewable energy projects, but as well as a lot of cross-border investment opportunities in renewables. And this is opportunity that Chelion Renewables, the company I established last year, our focus is. We do see that there are cross-border opportunities in renewables for many decades to come.
Thanks very much, Dr. Fang. We have this sort of ironic situation at the moment, don't we, where we know that the scale of investment needed to get the carbon footprint of the world down is very, very significant, and yet investors have targets, immediate targets that they want to also achieve, and yet they're finding it hard to find bankable renewable projects, or when they do, there's competition. And I think your point, which is to at least explore China, to look at what the opportunities are there, may be part of a bank of diversified renewables that institutions, for example, can look at as they meet their carbon targets. So I think that's a really important point. We are beginning to get run a little bit more out of time here, and I do have a few questions coming through. So I'd just like to finally turn to Grant, your observations, and this might actually pull things together because I think high net worths are demanding some changes, some developments, some maturing of the system. Could you go through what you're seeing in your community in terms of what people are looking for in terms of the structure of markets, the available products, etc.?
Yeah, sure, Mark. I think one of the clear trend, especially in the mindset, I think, believe it or not, is usually the macro view that drives people's decision over significant commitment to capital investments. And it's only on the micro, MICRO view that actually drives specific investment targets. So I think it's our task to actually put together the right macro view for our clients. And it seems that definitely comparing to a few years ago, people's mindset from the in terms of the investment decision is more from the offensive side to much more defensive recently. Probably from excitement to peace of mind seems to be the top priority in terms of their investing. And we actually have seen very clearly three types of investors. One is professional investors who actually are very comfortable looking for direct investment opportunities, especially like, for example, Dr. Pang's renewable energy industry, definitely a hot topic there. And for this type of clients, we basically just provide them with direct investment opportunities, and they're sophisticated and are, have pretty high awareness of the risks that involve. And the other end of investor, much more retail, if you will, the DIY type. They actually are more comfortable doing all the investment decisions on our technology platform. So basically, they select their own products and they make their own orders. and complete the transactions by themselves. So our RM actually rather, rarely step in just to kind of help them through the navigation of the website. I think majority of the investors, our clients, probably a good sample of the investor community, is in the middle. They still appreciate the advice you give them, as well as the selection of products for them. I think right now, we're playing much, a little bit like a role of gatekeeper in terms of probably preventing people from making too aggressive investment decisions, especially in domestic primary market. I think everybody probably will, on the call, will agree that the valuation of this type of investments are going to go through a very significant round of adjustments. So it's probably not the best time to make heavy investments in this area, but rather probably more like fixed income products or even some plain vanilla bank deposits, with the increasing interest rate is something that we would definitely recommend to our clients. So basically, I think it's the change of mindset, and also the behavior is much more defensive rather than offensive behavior.
Thanks very much, Grant. And I think, as we know, the development of deepening of the capital markets, more experienced by people. There's one thing to get great wealth early, another thing to keep it and develop it, and it's getting advice through people like yourselves and smart investors to help the maturing of the financial system. And it's good to hear that both your clients are looking for it, but also there are products being developed. And we mentioned before about derivatives, for example, the use of risk management. I might just go quickly to a couple of questions, and we do not have a lot of time. So I might ask the panelists to be quite brief in your answers if you don't mind. But the first one's for you, Tommy. I'm being asked here, and it gets to a core issue, and I think it's good to hear a contrarian asking this question. The market's been heavily oversold. Technology stocks have, everyone understands technology stocks have performed poorly both around the world, but in China really led the way in some ways. What are you looking at as a sort of contrarian investor? Is it time to step into those markets yet, or what sort of kind of approach are you taking to the aspect that a lot of bad news in the prices, arguably?
Sure. Without going into the details, so I definitely would make a case, given the rates and the monetary environment of China. So the growth in the tech sector should be the area investors should be looking into that. PCLB is right here in Hong Kong, and going through. So I'm optimistic about some of the results by the end of the year. But at the same time, there are a lot of uncertainty in the market. So definitely recommend clients to look at the longer term, spend the time, not only allocating money, but also your time and effort into China investing, stay invested, and at the same time, stay hedged.
And Tom, just I have got a question, another one directed to you, so just perhaps briefly. This is to do with China and the US reaching agreements about accounting and auditing standards and other issues. And I was talking to a fellow investor today who I described as having a very strong skeptical view to every investment he makes, but was talking up that there is a desire inside China to lift the standards of governance and some of those areas. Do you have a strong view as a firm as to how that's developing?
Yeah. So as I mentioned, so I'm cautiously optimistic, but at the same time, as Dr. Pang also alluded to, there are great company renewable looking for global expansion. So there are GDRs and other markets, right? So we have seen global investors looking for all channels and all venues, but at the same time, just to need to assess the valuation and address the uncertainty in the near term.
Great. And the next question is for you, Grant, and you've sort of touched on this already, but you might just want to just give us a final comment, really, which is around the strategic changes in asset allocation post-COVID. You've talked about helping people take a more cautious line, I think, being better, more diversified. Are you sort of planning for a change in that asset allocation into 2023? Do you have a sort of a framework that you're looking at?
Yeah, absolutely. I think one of the driving view is that we want to be safe to actually navigate through the uncertain times. I think echoing what Tommy mentioned before, we do see a recovery of domestic economy probably towards the fourth quarter, at least early part of next year. So we're actually asking people to start looking at, especially their liquidity and preparing ammunition for potential investing opportunities in the coming year. So I think our CI view actually is formed and re-emphasized every half a year. And we're actually looking at both global and domestically on potential investing opportunities that we'll recommend to our clients. But we're definitely optimistic about 2023 as it's post-pandemic, and hopefully the relief on the policy in terms of the COVID quarantine policy.
Thanks, Grant. And Dr. Pang, I've got a question here, and I think it's probably from an investor who's got experience, because this is a global phenomenon. The selection of suppliers, selection of developers, and the way you go about, kind of actually applying to renewable investments. I know there's been challenges with rising costs and other issues, and the stability of developers. You obviously get involved in that process. How are you seeing things at the moment, and what's your sort of techniques to manage those sort of risks?
Thanks, Mark. This is a great question, because in renewable investment, previously, people always focus only on renewable technologies, because project itself usually receive government subsidy. So in a sense, only in the last couple of years, renewable projects become truly market price, market driven. So as a result, one thing I believe with a lot of potential going forward is investment opportunities in developers, investment opportunities in operators of the projects, development of the projects. And for developers, the most important skills are two. One is technology skills, because once you include the renewables plus storage, there's a more technical challenge involved. Second one is it's important to have a robust supply chain management skills, because it will involve global supply chains. And lastly is skills to involve financial market, technology, and as well as operations. So these are new skills that are required to successfully develop, successfully grow a renewable market. In the past, it's quite different. In the past, in developed countries and in China as well, it's government subsidies. It's a minority sort of a specialty market. Now, since it's competitive with fossil fuel-based electricity, it becomes a major asset type. So we are seeing a transition from a government subsidized specialty investment opportunity into a much larger, I mean, this could be 10 to 20% the size of a GDP of a country. So this is a major asset class that ranges from holding the power plant itself. That's almost like quasi fixed income kind of risks, as well as investing in early technology companies. Those are just like technology investments. So renewable covers the full range of investment potentials and opportunities.
Great, thanks very much. I just got one final question for Yin, if I could. The question relates to, you've obviously advised seasoned investors in China. People have been there for many years. I'm sure you do very active work on a day-to-day basis. But what about those that are looking early on or need to bring their investment committees along or others to understand the regulatory environment? What sort of techniques do you sort of encourage them, presumably have a conversation with people early? But maybe give us a sense for what you've learned in advising people over time.
Sure, we've been navigating a lot of those clients, to explore business opportunities in China. Well, I think my advice number one is, to fully understand what are the available options on the markets and to choose, the optimal one for their own, to achieve their own business objectives. So it's like, with all the mutual access programs, the Connect schemes, QFII, and also the options to set up onshore asset management entities. I think it's like going into a Chinese restaurant. You're looking at a menu which is becoming longer and longer, and there are many different sets. And so it all depends on your own appetite, to choose the most suitable dishes and enjoy your meal. Yeah, and my advice number two would be, well, to engage professional advisors as early as possible in that process, because, well, as mentioned, China's regulatory and legal environment is rather unique. And also the markets is still under speedy growth, because if we look back, China's asset management industry has a tenfold increase over a decade, and it's hard to imagine elsewhere in the world. So yeah, I think you really need to have a good legal advisor, and also the financial advisors like UBS, like NOAA, to navigate the process and to fully understand the environment. Yeah, that's my advice. Thanks, Mark.
Thanks very much, Yin. This is probably the most politest panel to each other that I've ever been involved with compliments to each other. So I think that's a good sign. But I'd like to thank the panel, because I think it's been a sort of honest discussion. I think, Grant, you've talked about advising clients not to get too carried away. Tommy, you've talked about getting the timing right, the environment right. Dr. Pang, you've talked about the kind of real upside in renewables, but also the sort of lessons that you need to learn. Of course, you've just been talking about getting the legals right. Although, as we said throughout the discussion here, there's been a series of consistent policies being applied, which is generally favourable towards two-way trade, flows of capital and diversification for Chinese investors outwards, and also, for the opportunity for investors to go inwards. So I'd like to thank the panel. It's kind of a mixed panel for that reason. I'm sure you can reach out to any of the panelists if you've got any further questions in their area of speciality. But it's been a real pleasure to sort of have this discussion, to listen to the panelists' observations, and of course, all of us will form our own view on your allocation to China. But there's no question that China is going to be a big part of capital markets, whichever way you look, and you're going to have to form a view about it as an investor. So hopefully this has helped you in that journey if you're not currently already engaged. So thanks again to the panelists, and I'd like to wish you all the best for the next session. Thanks very much.
Thank you.
I'm Rob Wallace, the Chief Executive Officer of Stanford Management Company, which manages the Stanford University Endowment. It is a true delight and honor to have a chance today to bring you a conversation with Michael Spence. Mike is one of the most distinguished economists in the world. He is the Philip H. Knight Professor of the Graduate School of Business at Stanford, where he was also Dean from 1990 to 1999. Mike is a Senior Fellow at the Hoover Institution at Stanford. He is a member of the American Economic Association and a Fellow of the American Academy, and former Chairman of the National Research Council Board on Science, Technology, and Economic Policy. Earlier in his career, Mike was a Professor of Economics and Business Administration at Harvard, where he was also Dean of the Faculty of Arts and Sciences from 1984 to 1990. The many, and I do mean many, awards and accolades that Mike has won in his career include the Nobel Prize in Economics for his work on markets with asymmetric information, a subject very close to all investors' hearts, the John Bates Clark Medal, awarded to the most accomplished economist under 40, and the J.K. Galbraith Prize for Excellence in Teaching. Mike was a Rhodes Scholar and a Danforth Fellow, receiving degrees from Princeton, Oxford, and Harvard. Mike has served on the boards of General Mills, Siebel Systems, Nike, Exalt, and a number of private companies. Believe me when I say I could go on and tell you more about Mike's remarkable career, but in the interests of time, let me get to the conversation with Mike. Mike, thanks so much for joining us.
Great to be with you, Rob. It's good to see you.
We are speaking at a dynamic moment in the global economy. Inflation, rising interest rates, a war in Europe, perhaps a reversal of some aspects of globalization, and shifting labor market dynamics, all of which you know a lot about. What are the main economic issues on which you are focused right now, Mike?
Well, Rob, I mean, I think, the short version of it is when you add all those things that you just mentioned together is a kind of regime change. So to me, just speaking as an economist, setting aside investment considerations for the moment, we lived in a world of 3 to 4 decades with pretty powerful deflationary forces operating. And more recently, we've lived in a period in which, in spite of huge injections of liquidity, we didn't see really any inflation at all. In fact, inflation, has been below targets. And now all of a sudden, we find ourselves in a different world. It's easy to attribute this to the pandemic, and some of that's true. There are residual effects like zero COVID tolerance in China and so on. But the fundamental fact is that those deflationary forces are fading fairly fast. We don't have an unlimited supply of unutilized productive resources anymore in the developing world, which is an important source of that deflationary pressure. And as a result of that, and the labor market, shifts, aging in the global but we have, if you take the global economy, 75% of it resides in countries with significant aging populations and, different labor market conditions. The war in Ukraine has produced, the energy and food price, turbocharge. And finally, because we live in a shock-prone world, climate, war, pandemics, geopolitical tensions, and potential sort of almost blackmail, you're seeing a pattern of diversification. The clearest case is Europe, because we're doing it at high speed, diversifying away from Russian fossil fuels. But all of these things are expensive and they take time and they're creating inflationary pressure. So, to bring it back to things that really matter, these things, some of them are transitory, but a lot of them aren't going to go away. I call them secular. And I think we're going to live in a world in which the framework for fiscal and monetary policy is going to have to be very different than anything that we've been used to for at least 2 decades.
You've talked, Mike, in the past about the ways in which global developed economies enable emerging economies to scale much faster than they otherwise would through access to information technology and scale markets. Do any of the factors you just mentioned change the way that you think about that dynamic?
Well, absolutely, yes. I mean, so I'll try not to be long-winded. The digital technology revolution, which is one of the major transformations we're in, along with a biomedical one, and a huge energy transition, and multi-decade energy transition in front of us. But the digital one is going to make a lot of manufacturing and a good chunk of logistics not labor intensive anymore. And the development model that worked at high speed, as you just said, Rob, was one in which, basically low labor costs were the source of comparative advantage. Countries specialized on the export sectors and had an almost infinitely large global market to sell to. That source of comparative advantage hasn't disappeared, but it's fading pretty quickly. And then when you add to that, really fragile fiscal conditions as a result of the pandemic in a lot of emerging economies, not all. I mean, I don't want to throw China and India into this bucket, and climate shocks that are really quite substantial. And you've got a situation in which, I think the headwinds are pretty strong. I mean, it's probably an exaggeration, but it's starting to look like a perfect storm. And for investors, there's a significant chance that the rising value of the dollar is going to produce some pretty high-speed capital movements that destabilize financial conditions in a lot of countries out there. So yeah, this is a different environment and a pretty challenging one for these folks.
That's very interesting and concerning. So it sounds like you're anticipating obviously regime change, as you said, and things like the base level of price increase in the global economy, and a return to shortened production lines, shortened supply lines, nearshoring, reshoring, using automation and new technology to accomplish that. Yep,
absolutely. And a more fragmented global economy as a result. I mean, you mentioned that in the right as when we started. Yeah.
And do you maybe we'll come to this in a question or two, but do you see that fragmentation creating additional geopolitical tension as well?
Yeah, it's a little bit cause and effect. It's hard to know which one's which. So, I mean, so the United States is busy, contemplating putting additional semiconductor restrictions on, sales to China. I don't mean to prejudge whether that's the right or the wrong policy, but that certainly increases the level of tension because semiconductors are kind of crucial to running almost everything in an economy right now. Again, I don't mean to pick on that, but there's lots of different examples of this, and you could do it from the other side. But I think we're in a period of low trust, rising tensions, increasing restrictions. And a lot of us would like to try to find a way, if not to reverse course, at least to modify, a head-on rush into a global economy organized mainly by nationalism and national security considerations. But that seems to be the path we're on now.
Very interesting. Let me ask you one of those questions that everybody would like to ask you. If you were the Fed chairman today, how would you navigate this environment?
When Rob and I were talking about this before, I said I'd quit. But that's just kidding. Look, and I'm not a monetary experienced sort of monetary policy person, but in this environment, I think the issue is whether you can bring inflation. They have to bring inflation down. They're late to the game. They've admitted that. It's a complicated environment. I'm not inclined to be particularly harsh about that. But I think the critical thing to decide here, if you want to engineer some vague version of a soft landing, is to decide how fast you want to do it, like set a time frame, and then be a little bit data driven, while sticking to the time frame, and see if you can get inflation under control. If I had to pick a time frame, I think a year is way too short, given the forces we talked about before. But 2 to 3 years seems to be more sensible. And if we get there, then we'll be at least sort of back in some kind of equilibrium where the inflationary pressures aren't out of control. It's still a different world. I mean, I think it's important to caution everybody in business and on the investor side that once we get back in that equilibrium, it's not going to be the same one we were in before. We can't have a big fiscal stimulus or a huge investment sustainability without running the risk of inflation. That's really different from what we had before.
And national balance sheets are already fairly large on top of all of that.
Yeah, I mean, debt in particular, sovereign debt is, it ran up in the great financial crisis. It stabilized a bit, but continued to rise. And then the pandemic, was a kind of another major uptick.
Same question if you were the ECB chair.
Yeah, so they're in a really, really tough position, Rob, I think. The European economy generally is a lower growth environment. It's much more fragile. It is not energy independent. It is feeling, we're in for a very tough year. I'm in Milan, Italy. So when I say we, I mean we. And so the ECB can't sit by and watch inflation get out of control. The inflationary pressures are even larger here because of the energy transition and the costs associated with that. So they're again going to have to strike a balance, but a different balance. I think they'll tread slightly more lightly than the Fed because the Fed's operating in a stronger economic environment. I'm sure this is getting talked about at the forum, but the United States tightening has strengthened the dollar, which essentially exports inflation everywhere, including in Europe. I mean, we haven't seen the euro at par with the dollar for, 20 years more, or something like that. So it's just a very, very tough position. I think they're going to have to strike a balance between probably a different balance than the Fed will strike between getting inflation under control and not really tanking an economy, a set of economies that are pretty vulnerable.
It sounds difficult, a difficult balancing act. Something that's very much on my mind, and I think perhaps on a lot of investors' minds, if not all, asset prices have corrected. We've seen in the last 6 or 9 months some correction, at least in the U.S., a meaningful correction. But they remain well above their long-term historical averages. I'm thinking here of the cyclically adjusted price to earnings ratio of the S&P 500 or many other similar metrics. How do you think about the valuation of risk assets today against the macroeconomic backdrop?
Again, let me sort of flip to the conclusion. I would not be at all surprised if we see a further downward correction in asset prices. As you say, they're above historical averages, and this is a challenging economic environment. That's not to say that there aren't lots of interesting investment opportunities. And you and I both know lots of people, and in fact, you're probably one of them, that think sensible valuations is a better environment to invest. And lots of asset managers are kind of in the same boat. And even, volatility, provided you have some dry powder, some liquidity on hand, creates opportunities as well. So I, roughly speaking, I would expect a further downdrafts in the public markets. And you and I, and probably everybody else at the forum already knows that on the private market side, that adjustment takes time and is not anywhere near as far along. So probably we got another year to 18 months before the private valuations adjust to wherever we end up on the public side. I don't think this is a bad, trend, to be perfectly honest with you. I actually, it's not fun. And, in the interim, pretty much every asset's moving in the same direction. So diversification doesn't really provide much shelter. I get asked a lot by, people like my brother, should I start dumping things? And I say, no, you don't want to do that. You don't want to do that. You're probably no good at it. And none of the rest of us are that good at it either. I mean, there are probably exceptions. So there's going to come a time, I think, when bonds are a pretty interesting investment, even for people who don't actively trade for the first time in a long time, but we haven't finished the process of reaching that new equilibrium.
Right. That's helpful. Thank you. Yeah. It's very hard to market time, isn't it? You have to know when to get out and when to get back in, and have to get them both right.
Yeah.
You mentioned, you kind of gave an exemption to China and India in some of your earlier comments, or a partial exemption. I'd love you're an expert on China in particular. I'd love to get your thoughts on the Chinese economy and how you see its prospects and what the policymakers there are doing right now.
So there's a kind of longer term and the short term. So China has, done some things right, to make the transition to a high income country. It's just a powerhouse in terms of education, human capital, science, technology development. And in the past, they've had a pretty sure-footed economic policy making process, and they've maintained, in spite of the rhetoric, a reasonable balance between kind of public sector, involvement in the economy and a really dynamic private sector. More recently, Rob, I think they've been making mistakes, a lot of them. So I think, letting the property market, which is just a huge part of the Chinese economy, get out of control with excess debt, with letting people, who are buying apartments be part of the financing, I think that's just crazy. And so they're kind of trying to untangle that mess now. I think zero COVID, at this duration, is a mistake. And there's lots of, there's at least a little bit of evidence that there's lots of Chinese who agree. But I think, the thing that struck me was the extreme aggressiveness of the regulatory assault on the tech sector a couple of years ago. I think they're going to back off from that. Friends tell me that, there's likely to be a post-party Congress shift in economic policy back in the direction that we were used to before. And that's a good thing. I mean, nobody really benefits from a Chinese economy that's struggling. But for now, I mean, I would say at least for another year, things are looking, by Chinese standards, pretty grim, which is low single digits growth. And that's well below Chinese potential growth. I mean, Chinese potential growth is not as high as India's, because India's at an earlier stage. So I would say of the big economies in the world, India has the highest potential growth, but China can easily get back to 5 or 6%, and the fundamentals are still there. So the only other factor I'd mention, Rob, is, I think a fair amount of it depends on the evolution of geopolitical tension. So if we have a kind of constructive strategic competition with China, in which we each try not to fall behind too much, and we are going to have a strategic competition, there's absolutely no doubt about that. That's not a bad thing. It might even kind of prompt us to, do better on our side. Where it gets destructive and where it could really hurt the Chinese economy is when we try not only to kind of advance our own, frontier, but do things actively to hold the other one back. So the semiconductor thing would be an example of the second kind of behavior. And that, on a broad front, I don't think that'll, permanently knock China off its growth path, but it could sure slow them down.
Do you think China has a reasonable chance, if it's completely cut off from Western chip technology, to develop its own to the degree that would allow it to advance in the ways it wishes to?
Yeah, the major Chinese semiconductor firm says that they are close, like prototype close, to having a 7 nanometer chip, which is a huge advance for them. I mean, before that, people, again, it's really hard to know, but people have said, well, they're at 20 or 14 nanometers or some such thing, which is kind of way off the mark. TSMC's at 5 going to 3, so 7 isn't that far behind. So the way I think about it is, yeah, if they get cut off, it'll produce a lot of short-term pain, and it'll put them in investment mode and slow them down, but they'll eventually get there. I don't see any reason why. But there's a lot of things that can slow them down. I mean, there's a machine that's made in the Netherlands that's crucial for making 5 nanometer chips, because they're so dense. And so if they get cut off from that, then they got to develop that kind of machinery and equipment as well. So it could slow them down in a serious way. Yeah.
You mentioned a moment ago, India, with a very high potential growth rate. Things seem to be going well in India right now. Asset prices look a little high, but in general, things seem to be going well. What should we be looking for in India? What would you be happy to see, and what would be concerning to you in the next few years?
Well, right now it's politically stable, and the economic policies are good. Early investment in the kind of digital area goes way back to Rajiv Gandhi, produced the outsourcing boom, is now serving them very well. They're the home to a growing number of unicorns. The geo-revolution is hugely important because India went from basically high-cost cell phones and hugely high data rates to low-cost cell phones and some of the lowest data rates in the world. And 400 million new subscribers, or so, maybe that's out of date number, but it's the right order of magnitude, which has turbocharged the creation of these digital ecosystems, and brought India into the sort of global explosion of entrepreneurial activity, creating unicorns. I know there's some pain, at the moment in this asset price reset and valuation adjustment process and so on, but I don't think that knocks them out of the woods. I mean, I think the big deal in India has always been, are the employment engines powerful enough to bring all of the population along? You see, India really didn't ever join the Asia growth model story, right? It's never been, kind of China's successor as the manufacturing hub. Now there's a bit of that going on. Apple's moving over there. A lot of money that under the heading China's not investable at the moment is flowing into India, hence the pretty rich asset valuations that you're seeing. But I think on the fundamentals, India's it will never achieve the speeds China achieved, partly because it's just living in a complicated world. Well, last thing I'll say is, India is, I'm not sure this is going to get discussed at the forum a lot, but India is one of probably the most important country that I categorize as non-aligned. There's a huge set of countries in the world that have not adopted the sanctions, don't want to adopt the sanctions, don't want to go down the road of choosing up sides. And, they're important. They're a big part of the global economy. So, but that's a difficult road to navigate while the big players are sort of, rubbing each other the wrong way and fighting. So India could get caught somehow in the middle of that. I mean, they have close relationships with Russia. They buy arms from Russia. They're trying to maintain a balance and have good relationships with us. That's a ridge it's easy to fall off of.
Do you think when we think about the climate change challenge and the technologies that need to be developed and deployed and paid for, that we will find ways to work with India and China in that area? And how do you think about that problem?
I think we will find ways. I mean, because people now take it incredibly seriously as an existential threat. So maybe I'm being overly optimistic, and we can always have setbacks, as we did earlier in the year, that we did something that China, caused China to truncate the discussion of the sustainability agenda, but it wasn't permanent. China, but India is a long way to go. China is a major investor in sustainable, growth patterns and technologies. They're not nearly dominant in solar. That won't last forever. China's probably it's the biggest emitter in the world by a factor of 2. So if they drop out, then we're done, so to speak. They're probably going to peak in carbon emissions by 2030. And if they stay on the present course, they'll probably bring it down pretty quickly. So I'm cautiously optimistic. But in India, I think, the only thing I would say about India is that because India's growth is largely in its future, right? This is still a lower middle income country. Unlike China, China's got one more doubling to get to the low end of the kind of advanced country income levels. But India's got a lot further to go, and on that journey, their energy requirements are going to grow enormously. And so India is more cautious about making commitments in the climate change area. You'll notice that the advanced countries have sort of said 2050 for net zero. Directionally, China has said 2060. India has said 2070. Who knows if those are the right numbers and targets, but directionally it's right. So India is one of the big economies that probably has to join the party in a major way later. And the more technology flows globally from one place to another, the faster India and others can join. Making sure that whatever happens in the global economy, making sure that the climate-related technologies flow without friction around the world is just critically important.
Very, very important. Thank you. So let me just finish, Mike, with a question from the investor's perspective. If you were managing an educational endowment or any other pool of institutional capital, what would you be putting all of this together, the regime change in monetary and fiscal policy, inflation versus deflation, changes in how goods are manufactured and supplied and services around the world, set against current asset prices. If you were putting a hat on like my hat on, what would you be thinking about over the next 2 or 3 years?
I should ask you that question, Rob. You're wearing that hat all the time.
I'm the interviewer.
I know. And you've got a very large pool of assets. It's something on the order of 37 billion to deploy. So you have some of the people like me who have much smaller balance sheets have options that probably you don't have at that scale. Look, let me be honest. I would not try to duck the current downwinds. It's just going to be a tough year, and turning in a good performance on a relative basis is just fine when these winds are blowing the way they are. Second, I know you do this anyway, but I would rely on experienced investors who have seen crises before, and major sort of turns in markets, so they know how to handle it. They know how to, invest, when the prices get more reasonable. One of the things, I talked to an entrepreneur here in Italy, a very good friend of mine. He told me that there's nobody in his company other than him who's ever experienced inflation at all, right? Zero. And not only that, he said the information systems on which we run the company don't have any provisions for inflation either. We have to rebuild all those. And, there's a generation of people in the financial world who've just never experienced this. They're going to learn a lot on the way through this. But, in the meantime, I think, managers with long track records who've seen these things before and know how to, when to react, when to just, hold them and not. And the other thing I would say, and again, I'm not telling you anything you don't know, but there is a global explosion of entrepreneurial activity in a number of growth sectors, multiple digital ones, now biomedical and life sciences, probably materials, although it's a little bit less talked about, it's probably hugely important. And then the energy transition, which has a growing sort of tech investment ecosystem associated with it, and it is global. Is this an environment that's short of investment opportunities? I don't think so. It's just probably going to be a tough year. So that's kind of, and that's when I say that, that's kind of what I try to do at my rather small scale, is just figure out where those opportunities are, find managers who are willing to take me on that I know are experienced and trustworthy. And I think because there's a geographic component, one of the things I've learned is you really need people who are on the ground, and even, employing locals. I mean, you and I, Stanford for sure, and I also have found a way to invest in China, but for a long time I didn't know how to do it. I'd ask friends, how do we invest in China? And they'd say, well, it's not very easy. You can't do that. Well, now you've got, the Sequoias and a whole bunch of, Hill House, etc. or just top flight investors with super talented young Chinese people, sort of, know how to navigate, know which sectors to stay away from, all this kind of thing. Those are the things that I think are important. The other thing I've learned over time, and I'll just leave it at this, is, it used to be when I was young, this is a long time ago, we talked about we're investing in real estate stock, meaning your house, stocks and bonds. I mean, this world's so far from that in terms of asset classes, complexity, geography, and other things that I think you just have to go and rely on people who know what they're doing and can navigate.
Mike, that sounds like the right advice to me as well. So thank you very much for sharing that. Ladies and gentlemen, it's been such a pleasure to speak with Michael Spence, Nobel laureate, economist. Mike, thanks for your thoughts and your time.
Thank you, Rob. Enjoyed being with you.
Combined with days 1 and 2, what an amazing set of reflections, insights, and forecasts related to investments globally from our panelists today. We probably have more economic and geopolitical uncertainty right now than we've had in decades. And that's clearly what's playing out currently with the recent stock market correction and increased volatility. We have a backdrop of a U.S. Federal Reserve and other central banks that have been and are currently focused on lifting rates in order to slow consumer and business spending, investment, and hiring. These are daunting goals and appear to have a long way to go in order to meet their significantly lower target inflation objectives. But let's also not forget that politically, there's two very important events playing out. One is at the end of the week in China, where President Xi will likely be confirmed for an unusual third term. And in less than 30 days, we have a U.S. midterm election that will impact both what Congress can get done over the next 2 years, as well as the second half of President Biden's term in office. Anyway, lots to think about, and hopefully your understanding of the risks, issues, and opportunities has increased meaningfully as a result of you being a part of the Greenwich Economic Forum over the past 3 days. We also want to bring to your attention our next big event will be in Miami at the end of February. It's a winter GEF of sorts that continues the GEF conversation, and it's a slightly smaller version of our annual conference, but in a warmer climate in the wintertime. Please see our website for additional information. Anyway, thank you for joining GEF for the past 3 days. We look forward to seeing you at our next event. Thanks so much.